All right. Good evening, guys. Ken at Tortoise Capital. This is the Friday night podcast for September 11th, 2020. I want to begin with a moment of silence for 3,000 soldiers, civilians who lost their lives 19 years ago. Thank you to their memories. All right, let's see what we got here. So yesterday was problematic. We had a day that voted down in a big way. There had been the 4-day sell-off, and then things felt like, simple recovery, but that recovery could not break out above or penetrate the skin of the dragon, couldn't break above that key price level at 342.68. Yesterday was a return of the selling pressure, a big day down that closed poorly. And so we were concerned about what Friday would be. What was the willingness of people to hold those positions over the weekend? Was there going to be some violent price movement today to jockey for position with tactical trading, with leverage? Would there be a rush to sell in order to lock in whatever may still remain from the gains from back here and previously? With price at this level, we've already given back this much. And so what's the urge to protect that second leg up? So what we got was a slight gap up, came halfway up yesterday's stack, couldn't even get to the Bollinger Band mean, rolled over, sold off, and then had a minor recovery to close about mid-range of the day with only a fractional improvement over yesterday's price. Come on. Come on. We made a new 10-day low. God dang it. Come on now. So we made a new 10-day low. It briefly went below the Z-1. We didn't get the big, horrible sell-off that we had templated from yesterday as a real possibility. So this felt more like just a tactical exploration, but the buying pressure came back in to push it back up through Z1, through yesterday's low, to close basically where it closed yesterday. So this was, if I was going to classify this as the 10th round in a heavyweight boxing match, this one would be a draw. There was no decisive win for the Bears. The Bulls couldn't do much with it, but it didn't get materially worse. So if anything, slight improvement to the Bear side of the equation, because it did make a new 10-day low. And the Bears were able to keep it from being exploited as a buy on dip opportunity. So this just feels like a kind of a sloppy end or a painful close to what's been a horrible week, where the initial sell-off from last week was doubled this week, and we've got two legs down, and now we're down here at Z1, and everybody's suffering together, wondering what the new week will bring. So that's kind of my characterization of the price action today. Let me clean off this ink real quick. When we're looking at the week ahead, some support levels that are on our mind. Come on. Screen freezing on me here. Come on. There we go. All right, so taking a look at the week ahead, there's really no support level until we get down to the Z-2 and this previous cluster of support, which kind of coincides with long-term fair value around 326 to 325. So there's some vulnerability for another almost a 2% sell-off is still baked into the cake before we even get the first serious test of support. It's another 2% down to the 30-day low, which was made 30 days ago. Now, what makes this even more problematic next week is that the 30-day low is now going to come up here to about 328 because this previous 30-day low down here is going to move up to here. So there's sort of a time compression, and now you can see that the that 30-day period is now almost a V top, whereas before we had a nice long series of grinds and then a bit of a sell-off. Now, as time progresses, that's now going to become basically a V top, and then if we don't get any rebound, this thing's going to just look like a sell-off and then some recovery. So that's what's baked into the cake. Now, I want to draw attention to the RL30, which is the health of the trend. That's our RL30 line, and this is our projection of that slope. So when you take that slope and project it, this is the the area of tactical recovery. It's until it gets through this noise. This is all kind of a noise barrier right in here. So price can tactically go up in here, and it doesn't mean anything until it can kind of break through the RL30 and then through this declining PSAR. So here's where the PSAR is going to be on Monday at about 352 until it gets through the boundary of the RL30 and then the PSAR and then ultimately above the RL10 peak. It's not truly a confirmed bull until that happens. So this is really just the first series of noise barriers. And so every price that comes up here and then gets rejected is an opportunity now to get short because we are on the wrong side of the Bollinger Band mean. And the dragon has rolled over. And so now the bias is down until proven otherwise. So there are some tactical long side trades we can take intraday, but we're going to be respectful of these layers of resistance that have to be defeated before we can truly say that the unconstrained bull is back. On the downside, peak RL 270, the Z2, the 30-day low, and then the current long-term fair value is still down here at 317. There was a time several months ago when that was at 280. So it's actually, that bullish move off the bottom is not to be discounted. It's just that this move up to the peak around 355 and 360 was just so powerful that it left that long-term fair value behind. That's just a measure of how strong that move was. All right. Let's take a look at things that worked today. Find the S&P here. So the S&P was basically flat at a 0.05%. The Russell was the worst. U.S. index minus 0.67. So the tactical traders were having none of the upside. So there was the tactical traders certainly had a short side bias. Treasuries was stuck in the middle here at a 0.21. So slightly better than the S&P. And then the Dow large caps were the solid index today at plus 0.47. In the sectors, so the S&P at 0.05, these sectors were slightly better. Energy at 0.09, consumer discretionary 0.15, silver at 0.18, oil exploration at 0.36, healthcare 0.4, finance 0.7, clean energy 0.7, oil and emerging markets at 0.93, 0.97, materials 1.28, Japan 1.3, Mexico 1.8. In the companies that did well, we want to highlight. So Caterpillar was 0.265. So Caterpillar has been the company of the moment this week. During the big sell-off of earlier this week, it actually made a little bit. So the day the market sold off almost 3%, Caterpillar made a quarter. Yesterday, Caterpillar was one of the key leaders when the market was selling off. Caterpillar was good. Today, the market was flat, but Caterpillar was up 2.6. So the last 3 days, Caterpillar has distinguished itself from its sector, and its sector was better than the market. So Caterpillar is an example of how you can find stories by looking for the divergences, looking on the extremes of performance, and seeing the things that have an underlying logic that we can then exploit for a period of time. So Caterpillar was like that. The other one I want to mention is this Bill Ackman hedge fund, PSHZF. So this is swing tradable. It's not really day tradable because there's not that much volume to it. But what I've noticed is that on days when the market was down this week, that was up a fraction. On days when the market was flat, like today, it's up a significant amount, 1.37. And on days when the market cratered, this thing actually was pretty good. So there's some good tactical and operational trading going on inside that fund that is pretty well positioned for the current climate of volatility and chaos. So I have some money in that one, and I'm continuing to explore for evidence of good management in troubling times. And I think that's the case. Another story stock in the large caps that's similar to Caterpillar is Home Depot. Prior to the last 2 weeks, Home Depot had been maybe the dominant stock in the Dow 30, and then it suffered along with everything else during the capturing of profits. but it has rebounded nicely. And again, on a day when the market was flat, it was up. Yesterday, when the market sold off, it sold off less than the market. So Home Depot, Caterpillar, McDonald's, Disney, these are symbols that seem to be possessors of some relative strength compared to the market. They don't suffer from the volatility of tech. And so that may be a way to uncover some conservative growth potential among the large caps. So Caterpillar, Home Depot are on my short list for that. I would contrast those two with two other stocks that did well today, Boeing and Alcoa, who are near the top of the stack, but they haven't been consistently outperforming in good times and bad. This looks more like a response to sector cycling, so that when materials were bad, Alcoa was really bad. So it wasn't better than its sector. It just so happens that XLB has been starting to outperform, and then Alcoa has been pulled along as part of that. Whereas Caterpillar and Home Depot have been making relative gains consistently. Boeing and Alcoa have been more cyclic in nature. I would add to that same bit of cycling, Nucor and Devon. So like yesterday, Devon got absolutely slaughtered, but today it was up 1%. So you should look at those stocks as volatility cyclers, that when they're good, they're great. When they're bad, they're horrible. And trade them with some tactical care, as opposed to looking at them as long-term stores of value. The final company I want to talk about there is Goldman Sachs. So Goldman Sachs has been the best performer in the financial sector. Now, they were only at 0.45 and the sector was 0.69, but for most of the last 2 weeks, Goldman Sachs has been outperforming its own little sector. So maybe this is just a day of rest for Goldman. But whenever I find stocks that are consistently outperforming their sector, and when the sector is outperforming the market, then that becomes one of my rules of thumb about how to quickly find a stable mover. And then those become the kinds of symbols that I'm willing to hold on swing trades when I'm ready to swing trade. I'm not ready to swing trade right now, but I will be soon. So to display this, graphically, when the S&P was up big, that PSHZF was better. That's the Bill Ackman fund, had double plus. And when the S&P was flat, PSHF was up. And when the S&P was horrible, PSHZF was flat. So in all three conditions, when the market is up, when the market is sideways, and when the market is down, PSHZF is outperforming under all conditions. So that's different than just being a leveraged play on the S&P. That means that if these are the holdings of SPY, that the holdings of PSHZF are different, and those are things that are going up in spite of the market going down or the market going sideways. And even if the market's going up, PSHZF is doing even better. That's the same reason we were looking at Wiz several months ago, to see if their AI-induced portfolio would give you an advantage in holding composition, or maybe in the rules for tactical trading. But PSHZF seems to be a candidate like that. Now, when I take a look at the sectors then, so there is a time when XLB was worse than SPY. And when XLB was bad, Alcoa was worse than XLB. But then there comes a time when XLB cycles, and so if the S&P is just cruising along like this, XLB goes from oversold to outperforming. Well, when XLB is doing that this last couple days, then Alcoa, instead of underperforming, Alcoa outperforms. So this is a case where you are getting leveraged performance in both directions, and that makes it more vulnerable to these volatile swings. So whereas the Bill Ackman fund just goes up or goes flat, you get a more of a consistent outperformance in every market condition. You get these wider swings in Alcoa. When it's bad, it's horrible. When it's better, it's great. So you have to treat something like Alcoa and Nucor and Devon. So Nucor, U.S. Steel, Alcoa, Devon Energy. That's in this more volatile tactical play. Not my first choice for swing trades, but on things like Caterpillar, Home Depot, McDonald's, and then for a while, Microsoft and Apple in Techland, XLK, were outperforming tech, which was outperforming the S&P. So that had some reasonable, consistent outperformance until XLK just got slaughtered, and then Microsoft and Apple both got beat up. Now, Apple is starting to outperform Microsoft. Microsoft is lagging. So in that pair of Microsoft and Apple, Apple is to be preferred. So if I can see a rebound beginning to happen in XLK and Apple continues to outperform, then Apple's going to be one of my early candidates to start building those swing positions. Now, once you get this idea of when the market is just kind of sideways, but then the market starts to oscillate. Then you get paid. Let's see if I can get another color in here. So if this is SPY right here, if I can then see XLB oscillating even more wildly, I can now start looking for these turning points and trade the sector. And then if I can see a symbol like Alcoa, come on. Boy. So now if I can see a symbol like Alcoa that's even more volatile than the sector, at these certain turning points, if I can see the S&P turning and XLB turning and Alcoa turning, then it may be that I can tap into the extreme outperformance of Alcoa and get the greater volatility in my direction. And then Eugene points out that, yeah, if you can identify those turning points, either on the bottom or on the top, you now have critical states, and then you can start looking at options to start framing high risk reward opportunities. And then if you look at Danny's postings, you'll see how he does that. He just did a posting today on improving his win rate with straddles that's instructive as part of his options course, which is highly recommended. All right, so let's take a look at the underperformers now. So we had the S&P at basically flat. We'll look at the sectors of underperformance now. The FANG companies, Facebook, Apple, Amazon, Netflix, Google, slightly underperformed at down a quarter. Brazil minus 0.43, tech minus 0.76, Wheat and precious minus 0.88. The triple techs, both off about 2.2 to 2.7. Simon Property Group for the commercial real estate down 3%. VIX down 6%. Nikola has just been getting slammed in the press by short sellers, calling them a fraud and whatnot. And so, if you were able to borrow those shares to go short, there was just some amazing plays the last 5 days. This was the day of the 40% gain, and then we identified the opportunity here as a critical state, and it broke out, and so we've been able to take advantage of a sell-off from about 48 down to 31, which is about a 17 on 48. That's about a third. That's about a 30% sell-off inside there. And now it's all back to the same price levels when it got slaughtered before. So I think the easy money on the short side is done. They're going to try to litigate against some media and the short sellers, but good luck with that. The best way to defeat that kind of stuff is to buy low and sell high, and to produce a product that actually makes money and solves a problem in the world. They can figure out how to do that. They'll be doing okay. They're like Tesla without the superstar Carnival Barker. Just while we're here, take a quick look at Tesla, if we can. So Tesla, we identified this as a critical state down here, and it's been able to rebound nicely. Got all the way back up to 400. Sold off a little bit today, so I wouldn't be offended if you had taken today as a chance to lock in these gains. I think that's right in the middle of no man's land at the Bollinger Band main. I can justify a swing trade on that at 372 with a wide stop. Let's say down here at, if you took a 20% stop, that would be $60. That would get you down below Z2. So if you just accepted that much risk, and then you said, can I see 2 reward units above? Well, let's see. I think we can. One and 2. Yeah, that's the Tesla 2-to-1 reward to risk ratio. I also think that if it falls below that Bollinger Band mean, you could be short in this as like call that the red zone. But the rebounds in Tesla have been so strong that I would tend to do that more on the intraday rather than trying to hold a swing trade on it. So I think there's some possibilities in Tesla just from that. And so compare that to Nikola, which is just getting murdered. Same business, but Tesla has sorted it out much better. All right, let's take a look at some of the weekend charts. Which one is this? This is the let's wait that one. Look at monthly first. All right, so let's take a look at our monthly. So I would just notice that the previous 6 months have had higher closes than opens. So you can see that this month started here and closed here. This month opened here and closed there. This month opened here and closed there. This month opened and closed, opened and closed. So all that was good. This month, suffering. So that now feels like, as I say all the time, there's no such thing as easy money. But if there was, then this feels like the turning point for that phase. So this feels like the easier money. And so to me, the line to protect is about 330. There's no way that I'm going to risk the hard-earned money in here. And if you think back to where we were in June, that was the decision that we made right around at this price level, was to lock in those gains. With my core portfolio, I moved that out of the market and into long-term protected mode. And then I have been using swing trading and day trading, mostly day trading. In this period of time here, trying to play the shorter term volatility while preserving the gains that we made in here. So I still feel that was the right move, and I'm going to keep that same orientation until we get out of this election cycle. I just don't see any reason to change that assessment. So if we're looking at October, November, December, it's really this much time frame to me is still in the yellow zone. So this whole period of time just feels to me like the time of tribulations. So until we get out of that election cycle, I'm just going to be preserving my core capital. I'm going to be using swing trading, mostly day trading and swing trading during this entire yellow zone period of time to take advantage of this increased volatility, because this all feels like froth. This felt like the programmed response to the surprise sell-off. And this happened in 5 months, whereas the last sell-off from at the end of 2018, not quite as got to the same price level, but it only lost half as much. But it took that many months to work its way back up to here, and then it got crushed again, and it took 4 or 5 months to work its way up to here. This was the excess gains that I attribute to all that Fed money being pumped, and then the momentum and the overshoot, then the consolidation in the tech leaders, and then them getting slaughtered this last couple of weeks. So now we're kind of back to the edge of optimistic fair value. So while we see the next 50 days of election shenanigans, that is maximum uncertainty right in here. And so that's no time to start trying to pick, unless you've got some ideas that would take you out 1, 2, and 3 years about who's going to emerge out of the pack. That was the justification for loading up on tech inside here, but you can see how quickly that can dissipate. So what we're really looking for is who can emerge long-term, and by long-term, I mean 2 years, who can emerge longer term coming out of this fog of war to be the big winners. Who are those likely going to be? And that's going to be driven by who wins in November. You can just take a look at the difference of policy choices that are going to affect healthcare and manufacturing and trade with China and national borders. All of those things are open to significant potential policy changes in November, and it may not even be till January till we really find out who's going to win. That's going to be horrible. So I'm just battening down the hatches, taking advantage of tactical opportunities. That's how I'm reading the monthly. When we get to the weekly, it's kind of the same thing. You can see now that we're 2 full weeks into the selling pressure here. And then if I were to characterize the step 1, step 2, step 3 was really kind of the surprising one to me. And then this represents the excess gains beyond Z1. Those were when it got past Z1 and out of the river into the land of abnormal gains. My commentary earlier this week was to that effect, that if you take a look at the land between plus and minus, there's the average, and that's just basically been flat, right? And then if you treat the river as that range of normal, then you can see all of these gains were suspect between Z1 and Z2, and then the relatively rapid sell-off. And so the way we behave, the standard work for abnormal conditions is different than the work that we do in the boundaries between those. And then what we do in abnormal conditions when price is down here below that Z1 was different. We were heavily short. We got the turning point pretty well. And then once it crosses back into the land of normal, standard grinding and finding the leaders, now it's getting into abnormal gains, profit and capital preservation. And this is when we pulled the core capital out and then started managing the stops tighter and tighter as it moved up the stack. And that protected us against most of this short-term sell-off of the last couple of days. And that just comes from a recognition of when are we under normal conditions and what's the standard work, and when are we in abnormal conditions and what's the standard work. So that's what a market classification system should do for you, is to help you understand the difference between normal and abnormal, and then what your standard work is under those conditions. That's where you can have rules for one type of market condition and a different set of rules for other market conditions. So you need something that gives you a clear, actionable difference in expectations, if I may say it that way, and different strategies. So if I were to draw this with a little more precision, I should do it like this and say that these were kind of abnormal gains. And then the normal conditions occur when that thing comes back above Z0. So now if I can draw that this way. This is where those abnormal gains, or abnormal losses, I should say, are happening when it gets below Z1. And tighten up your seatbelts. It's going to be a bumpy ride. So special rules for how to trade when things are out of control. Special rules for when things are out of control but starting to recover. Standard rules for what to do during normal conditions. There's your RLXD and the supported spring crossing-ish. Up abnormal conditions, there's the rolling over of the RL10. That's where it becomes fall. So if we were to look at this almost as the four seasons, Hey, here is your winter, crosses the baby dragon, spring, summer. It's going to be fall here pretty soon. So the weekly chart with this standard array of from Z3 to Z3 gives you a pretty nice template, almost like a thermometer scale, of how to treat things and the difference between normal and abnormal. So I don't want to drone on too long about that, but do you need much more than that for market condition and market classification? If you're primarily a swing trader with end of day data, when you are in abnormal conditions, this is when you should be thinking about selective day trading to take advantage of the larger than normal volatility. In the same way that up in here, we get out of the swing trading and core trading and kind of been focusing on the daily tactical. But in terms of market classification, there's some good ideas on that page. As a alternative view, I want to take a look at treasuries right now, the so-called risk-free rate of return. And if you can just wrapping your head around that move, followed by this move, the risk-free rate of return. Really? Risk-free? But once you discount that, I am now looking at if I just draw this boundary here, and I'm just going to, so to me, that normal range is like between, let's just clean this up and say between 160 and 170 is the normal path going forward. And so now, if that remains stable, that Bollinger Band, there's 165. And I can backwards interpolate this and just say, that's kind of that's always been the yellow zone. And now I look at it like this and say, in terms of how I'm trading this thing, and when you get these exaggerated sell-offs, and when you see it reach those peaks around 170, I look at this price formation here as pretty favorable. Because I look at treasuries like this, belly of the RL10, that RL10 is going to peak, is going to start rolling up right there. And even if I pick that as the belly of the dragon and the belly of the RL10 and then the dragon belly here, this all feels a lot more stable. Now, I'm not saying that there's not a possibility for that downward, this kind of, that could surely happen. But that puts the stop at 155. And that's a $10 stop, which is about a 6%. So if you were trading the treasuries long from here and use 6%, could this get you 12%? So 2185 would have to get to here. That's not unreasonable. I also think if you were willing to have a tighter stop here, that's probably 2%. And now you only got to be able to see that much, and that's certainly within reach. So 173 is within reach. So I'll be watching to see if there's an increase in buying pressure in U.S. Treasuries as a way to be exposed to the U.S. markets, but without the extra volatility of the market. So I think that's still a pretty good move. All right. So that's my quick look at the U.S. markets. Let's go through the weekend report and see what we can see. And again, I'll be doing Q&As tomorrow morning, and then trade frames Sunday evening for the Sunday evening podcast. Usual. So we're still bullish normal, overbought long term, oversold short term. The risk Z is warning us we're not out of the woods by any means. This is the last time it was like here, it gave a rebound and recovery. So now, is it going to move up? Or is it going to be like this one that sold off from this price level? So this could just as easily continue to decay. That would represent another 6 or 7% sell-off if it did that. And that would be beyond a 10% sell, and that'd be painful. The blended monthly rebalancing is still looking at the U.S. and techs and consumer discretionaries. And then clean energy and wheat and precious are still outperforming longer term. The current set of winners halfway through the month, or a third of the way through the month, still is rewarding the same kind of, the broad sectors are still doing relatively better. Caterpillar, Apple. ETF2 is still at 100% exposed. We've already done the those health checks. Techs got assassinated this week. Japan was a store of value. Euro-Asia, large caps, store of value. Treasuries, recovering. So those to me look like, I guess if you're defensive oriented. Materials, as far as the sector, consumer discretionary, which is dominated by Amazon. Energy has just been lucrative on the downside, if we can say it that way. And financials, oddly, continue to underperform. ETF 32, wheat and precious metals coming back on the defensive play. Clean energy, PBW. You've heard me talk about those for a while. So it's a toss-up on techs, which ones got hurt harder, the Qs or the broad tech sector. But you can see that was the whole sector's problem, not just the key leaders. Energy and oil exploration, both very liquid, both very tradable. Treasury starting to stand out as an opportunity here. Still undervalued longer term, but showing some improvements on the shorter term. So maybe there's a turning point and a stabilizing point that we've already seen. We got to go look at food a little more. The agriculture index. The Dow 30, Nike, Cat, DuPont resisted that sell-off from the techs which techs got murdered. Microsoft got murdered. Home Depot and McDonald's. So it's the non-tech stores of value on great American companies that consumer the consumers who's getting protected now. If we just get Congress to print some money. Chevron, Walgreens, Boeing leading the way down. And Goldman, although it's been outperforming the financial sector, is certainly not overvalued yet. Techs in the world market model still kind of leading the way here. This is the Qs, and the U.S. large caps doing relatively well. Sweden and Germany handling COVID better than most. The energy sector getting slaughtered, driven by oil getting smashed, and compare that to gold. So DBC is that Commodities Index, which is a blend of 4 different kinds of commodities: base metals, precious metals, food, and energy. So you get a blend of that, whereas DBA is the agriculture component of that. DBC gives you that blended exposure. So that's been dragged down by energy so much that it offsets the gains that were in gold. And then in terms of relative strength, gold is leading, followed by the S&P at 37, but Treasury starting to play catch up. And real estate just lagging altogether. That defensive play is just, and I think that's just a reflection of the expected rise in mortgage failures once the rent moratoriums fall out, that a lot of property value could be at risk. I am not really seeing anybody too concerned about that in the political. That's a time bomb just waiting to land. And then I just got to tell you, the short-sighted government tactical plays are really starting to bother me. Like government employees just got a 4-month moratorium on payroll tax deductions. Here's what's insidious about that. It's just a moratorium. That means that they're seeing a 6 to 7% increase in their take-home pay for the next 4 months because they're not taking the taxes out. But those taxes are going to come due in January when a new administration comes in. So everybody that's not self-aware is going to think, oh, I got more money. But they then have to figure out how to not spend that money so that they can pay that incoming tax bill in January. If that isn't taking advantage of the gullibility of the public, I don't know what is. It is absolutely shameful. Irritating. ETF 2. I like materials here. It's green and white. Germany, green and white. South Korea, green and white. The growth index in the Russell, green and white. That's interesting. But otherwise, the defensive plays gold and silver, solid green, and even home construction, solid green. I should also say these ones in the green are the guys that are the 30 most liquid by daily dollar volume, and the ones that are in the green are also have excess volatility intraday and make great trading vehicles. So energy spider, the tech spider, the gold miners, silver itself, the Qs, Brazil, biotech and semis, oil exploration. That's how you read this chart to keep track of what's legit tradable. I'll just go take a look at the south side down here. Banking, oil, gas exploration, energy, and oil, and real estate, as if we needed more reminders. of how bad they are. Shifting to the daily now. Got some overreactions and channelings. It's all the U.S. indexes are above their 200-day moving average, but have pulled back below minus 80 on Williams percent R. So there's a buy on dip opportunity for the brave of heart. The 10-day min pains in the Dow, these are the ones that are dominant. And that's non-tech, every one of them. All consumer staples. And then Apple, Salesforce, Microsoft, Walgreens, Devon Energy, Apple, and then the oil energy sector of Halliburton and Conoco. Oil. 10-day max pains, the ones that have suffered the most. Just about everything on the auto framer. And that's a function of two things. There's still a considerable sell-off, but their daily ranges are starting to shrink. So now when you look at the reward of going to a 10-day high compared to the daily range, this is now starting to look favorable. So here's how you should think about that formula. And why that can be broadly taken as a market condition, right? So the general idea, again, in the auto framer, a risk ratio, a reward to risk ratio that tests the 10-day high using a mechanical entry. So if I have some symbol, and this was the 10-day high, and then that symbol sold off sharply, and then this day the range looked like this, then my mechanical frame for entry and my initial stop, that's my I stop, and this would be my mechanical entry. We would call this the range risk. So then I can measure that range risk and say, oh, if there was 1 and 2, then my auto framer reward to risk ratio would be 2 to 1. If this last day had been a very large candle and my range risk was like that, well, then I wouldn't see 2 to 1 to the upside. And then all of these symbols here would be less than 2 and they wouldn't fire. So once I've sold off from my 10-day high, and if that last day's range was small, as this range gets smaller, then the number of multiples up to the 10-day high gets large. So if I had a really small doji, I might have 1, 2, 3, 4, 5, 6, 7. I could have 7 to 1. The size of the reward is still the same. The reward is still the same. It's just the size of the risk is different. So whereas this one might be 3 to 1 because it had such a wide range, this one might be 7 to 1 because it had such a small range. Well, why do I prefer a 7 to 1? Well, the fact that the range is small says that the buying versus the selling pressure has stabilized, that the bears are no longer able to win the race and keep pushing this lower. So the fact that the range is getting smaller is an indication of buying pressure coming in. They're buying it sooner. It doesn't fall as far. So once the lid comes off that thing and it starts going back up, I have a smaller, manageable initial risk, and now I can get to no lose plus dinner for 2 faster with a larger position size. And then if this sell-off was large, maybe I'm only going to get a 50% retracement, and that's leg 1, and then that's leg 2. So I can aim for this, but I'll take that. So all other things being equal, the auto framer tells me the relative reward to risk against all of the symbols that are in this stack. In this case, the Dow 30. And everything better than 2 to 1 is highlighted. Now, there may be some other reasons I'm interested in, like Apple I'm interested in because it's got 4.3, but it's also a channeling and an overreaction. That's great. And it has been outperforming over longer term periods of time, but it's been suffering the last 1 day and 10 days. So that looks to me like a tactical opportunity that Apple has been dominating and then has made a measured pullback, but now there's a almost 5 to 1 reward to risk just to get back to the 10-day high. So Apple turns out to be a great trade. It's number 2 on the auto framer. And in terms of the max pain range compression, I like that one. So that's how the auto framer works. And then when you see a lot of symbols firing better than 2 to 1, this is a case of the entire market that the volatility of the sell-off is starting to shrink, that the daily ranges are getting smaller, which is the first sign of a return to normalcy, which is a return to potential for a grinding bullish move back up to the 10-day high. The last time it got to the 10-day high, it sold off. So if this one were to fight its way back up, this is where that 2R battle drill comes into play. And then I can preserve whatever gains I've made in here, but then I can be ready to exploit any breakout above this known resistance area. That's the essence of the 2R battle drill. That's the one you should listen to every day for 30 days until your eyeballs bleed. So we see the same thing now on the ETF 30. Plenty of auto framers. Technology, like here's what I love about the technology spider right there. Does anybody seriously think technology is not going to be the big leader 2 years from now? So here's a chance to buy it. It's channeling and overreaction. It's 3.4 to 1. It was a down day for it today compared to the other members of the or the ETF 30. So that's an opportunity. And then I think materials is just showing that that's resisted the sell-off. I think that's probably just because of book value, that at some point a steel company or now aluminum company has intrinsic value. Somebody's going to need metal someday. So when I see XLB and XLI, the industrials, both outperforming, that gives me, if I have any confidence short term, that's the kind of thing that would produce it. Microsoft, Apple, Cisco, and Gold have all fallen out of their river. I just think those are, why wouldn't a hedge fund or a pension fund manager take an opportunity to quietly buy tech leaders on sale? Does anybody think Microsoft and Apple aren't going to be big players for the next 10 years? And people are going to buy their hamburgers and drink Coca-Cola products and wear Nike shoes and sell bulldozers to the world. Caterpillar. No brainers. So many auto framers firing up, and that shouldn't surprise you given what we saw. Look, the oil and oil exploration, or energy and oil exploration, have sold off so much that they're offering amazing reward to risk. And even treasuries have sold off a little, and their volatility is so low that they have a nice auto framer on them right there. And I see Apple and Walmart. See the S&P in that same kind of market condition. So everything north of the S&P has either a greater rebound and or less volatility that makes it even more attractive than the S&P on the auto framer. So enough said about that. Squeezes on the daily chart: treasuries, gold, silver, and Goldman. These are the ones that had such narrow ranges today that the 1-day pop is possible. So let me just remind you again, since I'm in the mood, how this little feature works. So on the daily squeeze, what we're really looking at is the today's range divided by the average range. Okay, so if this thing is normally moving this much from the high to the low, and I come up with something like, oh, okay, so the average range in the is $1. Let's just call it that. And then the next day, this thing has such a tiny little doji that it's only 30 cents. I can take today's range, 30 cents, and then divide it by the average range of $1, which is, the average range of the last X days. And then I can take that as a sign that if I have mechanically traded this thing and it moves $1, just gives me an average range in either direction. I actually use the range stat. I'm going to get this. I've got a small risk of the daily range, and so Treasuries is offering 3.8 to 1 on this. So a 1-day pop. So that range was so tight that if all it does is move a range stat during the day, which is average range plus a frog box, if it just gives me a range stat move, the maximum reasonable intraday move, I get 3.8 to 1 using a full day's range as my risk. So anything better than 2 to 1 tells you that that thing was abnormally compressed. So it's a 1-day trade. It's like popcorn that's getting ready to pop, but it hasn't popped yet. And if it pops tomorrow, it's a big pop. So this is perfectly suited for swing trading 1 day at a time. I get more good ideas off of that chart for just simple 1-day pops. It's ridiculous. I have no directional bias. I don't have any longer term expectations. This is the case of normal volatility has suddenly evaporated to exceptionally small volatility. So it's like a little coiled spring ready to break in either direction. Perfect for straddles. So I got to talk to Danny about how to exploit that. I'll ask him to write something on that with options. The absence of volatility, the volatility is baked into the cake. When it explodes, it's a no-brainer. 1-day trade. And treasuries on that one is the big no-brainer. All right, everything dominated here in the fall. Some things starting to make the turn. Brazil or Mexico and gold. Treasuries in the spring. I'm liking it. Materials continuing to distinguish itself. Honeywell, McDonald's, Disney, and Cat. So Honeywell was one that added recently to the Dow, and that seems to be doing a little better than Salesforce, which is in the winter and suffering. But Honeywell is just a quiet, doggone good, diversified tech company with exceptional management. It's one of the case studies that I use in my doctoral managerial course. That's just a great company. And so many other things suffering in the fall. Chevron and United Health selling off recently. Apple and Microsoft. I still think that's an opportunity waiting to be framed. Yeah. I think this is the support level down here in Microsoft, and I just think that's the opportunity right there, just to get back to the Bollinger Band mean. That's just a screaming buy to me. I'll be on that like an ant on a picnic. Apple, same thing. It just feels like it's stabilized. Even to the top of the dragon. Second leg to the PSAR. Third leg to the previous peak. And then if you had to, this downside all the way down to here. And then if that breaks, down to the previous PSAR. Well, that's a critical state in Apple. I'll bet you $1 we make money on that one next week. I just don't know which direction. But whichever way it goes, I'm going, and I bet you we make money on it. I think it's going up. I would be least surprised on a rebound from a Z-1 sell-off. That's gone from 140 to 110. That's $30 on 150 would be a 20% sell on Apple. Just imagine you read some little newspaper advertisement there. Hey, 20% discount on Apple. Greatest consumer customer, greatest consumer company of the last 20 years, on sale for 20% off. Wouldn't a professional money manager find that like catnip? Seems like they should. We'll see. Trying to talk myself into buying Apple. Disney may have had a little temporary blip and allow it some opportunities. Coca-Cola, an anomaly. I wonder what that is all about. I have to go back and add Coke here. Can't catch them all. Yeah. Does that look like any of the other previous symbols? No, this thing is solid. Now it hasn't recovered as much. I'm gonna bring this back up into here. Oops. It has a lot longer to go to recover its previous glory. We get so used to the greatness of tech that Coca-Cola, I suppose a great American company. If you take all of that as the noise channel, it just broke out here lately and held off nicely, and now there's big room above. So I'm going to be a buyer of Coca-Cola here. That's buying Coke at 51 with an expectation at 50 and an expectation going to 60. That big green box is a 20% gain in Coke against a pretty tight range of support if you just use the PSAR. With a couple bucks of risk, chance to get 10, 5 to 1, simple. I leave the rest for you to frame. In the ETFs, the Russell and real estate lagging, the Q's on sale big time. I have no directional bias on Brazil. I just trade them like a frog. Japan held up store of value pretty well. Treasuries, I think, are at a turning point. And I think I could make the argument, I would take the side of the bet where they're going to do well going into the election. We'll see. Maybe that's such a stupidly obvious play that it's the wrong play. I don't know. I'm going to continue to maintain my coyote opportunistic mindset, and those are the targets that I'm looking at. So, Q&A for tomorrow. Trade frames Sunday night. Back to work on Monday. Let's get after it, guys. Take good care.